Oracle is an over $400 billion software company, and Wall Street has no idea how to value it. The shares have been valued as high as $300 a piece this year and as low as $125 a piece. And they're currently trading about $145 as I record this. However, they're down over 20% so far in 2026. But long-term investors know that it is the business and the operating trends that really make the difference in whether a stock is worth holding over the long term. That's why in this video, I'm going to walk through the recently filed 10Q report with highlights from someone who has analyzed, researched, and written about stocks for more than 10 years. We're going to cover how Oracle makes its money, its profitability, and most importantly, cash flow, so that you can feel as informed as possible by the end of this video when you're deciding whether or not to buy Oracle stock. So before we jump right into the 10Q report, let's take a look at the stock. And it is flat over the last year. We can see it's moved less than 1% in the last 52 weeks. If we zoom out, though, shares have more than doubled in the last 5 years. However, you can see a real big peak here. The all-time high was $308 a share in September, late 2025. Since then, it's down significantly, almost 50%, more than 50%. Here so far in 2026, shares are down 26%. As investors are concerned about things like AI disrupting the business or the company spending too much on AI and it disrupting actual profitability. So we're going to take a look at some highlights that I have here in the 10Q report that was, again, filed for the fiscal Q3 period in 2026 that ended in February 28th for Oracle. So let's look at management's discussion. A few things I wanted to highlight. How does the company make money? So they sell software and services to enterprises. As we say here, as the company says here, we sell to customers all over the world, including businesses of many sizes, government agencies, educational institutions, and resellers. So Oracle is different than a company like Microsoft, which has a significant consumer business. Oracle, in contrast, basically deals with large enterprises. And the biggest part of their business is their cloud software and services. They say represents about 86% of total revenues. We're going to see in a second it's closer to 88% right now. And out of that, it's really just cloud revenue that is mostly driving this business. It's responsible for just about all of the growth we're going to see here in a minute. The software is sort of the legacy business. That's smaller portion of the business and also not growing at all. And then we got the hardware business that Oracle estimates at about 5% of total revenue. And again, that's going to be a little bit different. That's on a 12-month basis, but this past quarter, I think it was less than 5%. And then services business is about 9%. And we can see here that management says that services business is less profitable than the other ones. So it's not one that we're going to want to see grow a lot for profitability. All right, we can see in this chart here on page 29 that Oracle is a very global business, but most of the growth is coming from the U.S. market. So we can see in the Americas, the U.S. market growth in this past quarter was 26%, and that market was worth $11.4 billion of the company's total 17 or so billion in revenue. Then we see second is East, Middle East, and Asia. That segment was worth $3.4 billion of that 17 billion and grew at a 16% pace. So the U.S. business is growing, and it is the biggest business. But we can also see here, if you look at the 9-month period, over the last 9 months, the U.S. business has grown at about a 20% rate, and now it's growing at a 26% rate for the most recent quarter. So we're seeing accelerating growth in the U.S. business, and that is a huge reason for optimism on the part of investors. This chart also shows profitability. So profit margin, anything above 20% as a rule of thumb, I normally consider really good. For a software business, 30% is fantastic. Microsoft is somewhere in that 40% range. Apple is somewhere in the 28% range. So Oracle, we can see here kind of in the middle, not as super profitable as Microsoft, but more profitable, or about as profitable as Apple at 30% of sales for the past 9 months. And operating margin increased slightly from 31% this past quarter to 32% of sales. That would be great news if investors could see that continue over the next several quarters into fiscal 2027. And then breaking down the business by segment, we can see that the cloud and software business grew at a 20% rate to $15 billion, which is, again, just about the entire business. 15 out of the $17 billion is in the cloud and software, which is good news because the other segments aren't doing too well. The hardware business declined at a 2% rate to $700 million, and then the services segment grew at just an 8% rate to $1.4 billion. And then we can also see here, cloud and software segment is worth 88% of the business right now. Hardware is worth 4%, and services are worth just 8%. Management does say here why sales grew at the 20% pace that we saw this quarter. The increase in our cloud and software business revenues was primarily due to growth in cloud revenues as customers purchased our applications and infrastructure technologies and renewed their related cloud contracts. So cloud applications contributed 15% of that growth, and cloud infrastructure, those are two elements of the cloud business. Cloud infrastructure contributed 85% of the business. So this tells a story of some concentration of growth. So it's all mostly happening in the United States. It's mostly happening in the cloud business, and it's mostly happening within the cloud business in just the infrastructure technology segment. This chart shows again some kind of good growth figures for just the cloud and services segment, so we can narrow that down a little better. Growth in the Americas again was 29%, the fastest by far of any segment, and that was worth 10 billion of the 15 billion in total revenues for that overall cloud and software revenue division. And we can see here that the total growth has been accelerating, grew at a 20% pace here in Q3 compared to a 16% pace for the wider 9-month period that encapsulates all 3 quarters of 2026 so far. And we can see cloud and software grew expense-wise at a 67% rate, so it's getting a little bit less profitable because expenses are growing much quicker than revenue, and that's why we saw profitability decline both on a 3-month period and on the 9-month period. So in this past quarter, operating profit margin for this segment, again, this is Oracle's biggest segment and most important segment, declined from 63% of sales to 58% of sales. And then in the 9-month period, we saw a similar decline from 63% of sales to 59% of sales. So overall, the business, we did see reported a slight increase of profit margin from, I think it was 30% to 31%. However, we're seeing, if you look under the hood a bit here, sales profitability is declining in the core business. And we're definitely going to want to watch that over the next couple quarters because management is spending money aggressively on this growth business. And if its margins are going to be declining, then that says some bad things about the valuation of the business going forward. And then revenue by offerings, we can see that the cloud applications segment grew at that 11% rate, so it wasn't responsible for much growth, but that is still slightly faster than the 10% rate we saw over the last 9 months. The cloud infrastructure business is really, again, the star of the show here. It grew at an 81% rate in Q3 compared to a 68% rate for the wider 9-month period. And then software is looking a little bit better. It's declining at a 2% rate compared to a 13% rate. And then the software support segment is basically flat in both periods and not really worth anything for growth. Management says here, total margin as a percent of revenues decreased in the period due to an increase in total expenses driven by higher infrastructure expenses to support growth in our cloud and infrastructure offerings. So they're spending aggressively on that, and we're going to see that impact cash flow here in a second. But before we get to that, let's look at research and development. We intend, management says, to continue to invest significantly in our R&D efforts because, in our judgment, they're essential to maintaining our competitive position. We did see R&D spending significant. They spent about $2.6 billion this quarter compared to $2.4 billion a year ago. However, as a percentage of sales, that has declined slightly. So we're looking at 15% of revenue being spent in R&D compared to 17% a year ago. And we're seeing that same trend if you zoom out in fiscal 2026 for those 9 months. R&D went down to 16% of sales from 18% of sales in 2025. SG&A expenses did decline though, so the company is cutting costs both on that and in sales and marketing. So that's a significant reason why we saw overall operating profit margin increase. SG&A dropped from 3% of sales to 2% in both the 9-month and the 3-month periods. And then interest expense here is definitely a big highlight here. Interest expense significantly increased. It was up 22% over the 9-month period and 32% just for this quarter. We're talking $1.2 billion in interest expense alone, and that's significant. And it's because the company recently took out that $43 billion in long-term debt over the last year. So they're paying significant interest on that. And we're going to see why the company needed to take on that debt here in just a second when we look at free cash flow. And the free cash flow chart, so we got net cash flow provided by operating activities increased 18%. Operating cash flow is a significant, important factor for investors to watch because it basically is the destiny of the business. You want positive cash flow and increasing cash flow as much as you can see that. Operating cash flow has now increased 18% from 15 billion to roughly 17 billion. However, our spending more than tripled, or essentially tripled, from $12 billion to $36 billion. And the company blames that on investments in capital assets to support the growth in our cloud and software businesses. We're seeing that with a lot of companies, like Meta is planning to spend over $130 billion in investing in its infrastructure, data infrastructure, and Oracle is also doing that same thing. However, the difference here is Oracle does not generate enough cash that it can do that without burning through some cash. And we're going to see right here in this free cash flow figure, to kind of sum up everything here. Capital expenditures in 2025 were 15 billion over that past year. Now, over the past year, capital expenditures have risen to over 48 billion, so more than 223% increase in capital expenditures. And because of that, free cash flow over the last 4 quarters has declined from a positive 5.8 billion to a negative 25 billion. So this is why the company had to take out some extra debt, some significant debt, and that's why they're paying a lot for their interest expenses. So that's not great news. So the company is burning through a significant amount of cash, and it's going to need to take on some more debt to do that. So what we have here all together is a business, I think, with accelerating growth, which is definitely significant. However, it's very focused on the cloud infrastructure segment. Even though this is a very diverse business, almost all of its growth is coming from one little segment right now. It does have excellent 30% profit margins, but as we saw, those margins are being pressured slightly, and we're seeing rising debt and exploding spending around AI. So it's a mixed picture about Oracle, and you can see why that has Wall Street analysts fighting bulls and bears over whether or not the stock is valued correctly at closer to $130 a share, or it might be worth closer to $300 a share. Tell me what you think, though, in the comments below. Let me know whether you think Oracle is a buy, sell, or hold at this price, and let me know what you want me to cover on the next video.